What happens to euro from here, Philip?
Well, we take a very top-down look at currencies, and the starting point is what's happening to the world economy, and in particular, what's the market looking at, and what's the likely outturn going to be. And clearly, markets are very concerned at the moment about global growth slowing down because of a potential tariff war, and one has to say that that is a risk. But our baseline case is that somehow the adults in the administration will win the argument in Washington, and there will be some sort of solution hammered out with Beijing, and that we won't see a big escalation of tariffs and non-tariff barriers being erected between the US, China, and indeed other countries. And from a GDP perspective, we're thinking, well, we probably won't get to 4% growth this year globally. A poor first quarter in a couple of areas probably scuppered that, but we'll get fairly close to it. And in that case, let's look at monetary policy. We are of the view that the ECB will cease its QE programme at the end of the year, as it's announced, and after a break of about 8 or 9 months, we'll get a tightening in monetary policy through the first rise in interest rates, specifically the deposit rate. That should support the euro.
Yep.
And an easing of trade tensions.
Perhaps. So what's your target?
At the end of this year, we're looking at 122 euro dollar.
Right.
We believe that we'll be fairly close to 130 at the end of 2019. Ironically, perhaps, the dollar is being supported by trade war threats, because a trade war wouldn't be specifically a US event. It would affect global growth. And in those circumstances, what would you expect? Well, you'd drift out of risk assets, you'd go into safe havens. What's the biggest safe haven market? It's US Treasuries. And therefore, if you see a reversal of that pattern, then what you should see is the euro benefiting, particularly if the ECB tightens policy next year.